Hello, my name is Yves Longchamp. I'm Head of Research at ETHENEA Switzerland. We do expect the Fed to hike rates for the first time in September this year. According to our analysis, all the conditions are met. First, on the labor market, jobs are created at about 240,000 per month in the last 12 months, which is quite fast. Unemployment has declined. We are at 5.3%, which is close to equilibrium, and wages are going up slightly. If we look at inflation, it's still low, but it is mainly due to oil prices. If you look at core inflation, which is a headline inflation without oil and food, we are at 1.3%. There is no inflation threat, but there is also no deflation. So it should be fine for the Fed. And finally, looking at activity and growth in particular, in the second quarter of the year, the US GDP increased by 2.3%, mainly due to consumption. And this is quite a good number, a robust number, when you know that exports were weak because of the strong US dollar and investment in the mining industry declined by 40%. To have 2.3% growth in the US is quite a robust figure. As a result, we expect that the Fed will increase interest rates for the first time on the 17th of September this year. The Eurozone as a whole is doing relatively well. And regarding Greece, I will talk to that a bit later. So let's look at Eurozone without Greece. Then there is a lot of differences between countries that are growing very fast, like Spain, for example, which is growing at 4% per quarter, 2 times faster than the US. We have also France and we have Italy, which are doing good and are improving, and Germany, which has some growth but is not improving. When you look on the other side, for example, on the labor market, you see also that unemployment is still high, 11%. It's twice more than in the US. It means that there is still some slack in the economy. So overall, in Europe, it's fine, it's working, it's growing, but very slowly, and this still remains fragile. Let's have a look now at Greece. Greece is different. Greece is probably entering a new phase of depression. And the key question is whether the Greek government is able and willing to implement the much-needed reforms. In the last couple of months, global trade weakened substantially. And when you look at where this weakness comes from, it comes from first Asia and in particular from China. When you look at commodity prices also, they declined a lot. And who is importing a lot? This is China. China imports from all commodities you can imagine. So it's quite clear to us that the weakness comes from China. And we are not the only one to be aware of that. The renminbi is close linked to the US dollar. There is a strong peg, and the US dollar is strong. So the People's Bank of China decided to weaken the currency versus the US dollar in order to boost exports and to support growth. And for us, this is extremely important to look at global trade because this is one of the nice ways to look at China. And if this weakness persists, this will be a big risk for our global macroeconomic scenario. Thank you very much and goodbye.